So what happens when high unemployment, stagnant economic growth combines and meets rising inflation? What you get is the term stagflation. First of all, it starts with supply shocks, where there is a surprising decline in certain consumer goods or products. Then there's a rapid expansion of the money supply. You have too much money chasing too few goods. And then you combine those factors with policy error. A lot of economists are raising the alarm bell for the potential for stagflation. We do have a significant supply chain disruption because we're still dealing with the negative implications from the lockdown we had in 2020. We're seeing a shortage of products from so many areas of the economy. In fact, if you look at this chart, it shows that manufacturing inventories are sitting at a record low. So we are in the midst of a significant supply chain disruption. We've seen since 2020, the federal government and the Federal Reserve have to significantly increase the money supply. These things combined are a recipe for inflation. The stagflation of the 1970s was the result of many different factors. When we look at the current economic environment and we look back at the 1970s, the most important thing is to break stagflation apart. The labor market. Yes, unemployment was rising significantly in the 1970s and 1980s. But that's a very different story than it is today, because in the 1970s, employers were forced to lay off workers because workers were demanding higher wages and their input costs had gone up so much with rising inflation. Fast forward to the current economic environment, and we have more job postings out there than we do have unemployed people. We have businesses that are willingly raising wages. Of course, economic growth is going to slow from those record rebound numbers we saw coming out of the pandemic. The biggest driver of GDP today, as you can see in this chart, is the consumer. The consumer makes up 70% of GDP. That's almost 10% more than they made up of GDP coming into the 1970s. And the consumer's healthy. The consumers want to spend. That's why we're seeing some of this supply shock is because of the pent-up demand. We all know that inflation has been elevated, and it has a lot to do with the supply chain disruptions and the tightness in the labor market. But the significant difference between today and the 1970s is the Federal Reserve and monetary policy. So in order to understand this, let's just zoom out and understand that the Federal Reserve today walks a very fine line between balancing maximum employment with stable prices. It's a challenging feat for anyone to do. And in the 1970s, instead of worrying about inflation, they were swayed by federal officials who wanted them to focus simply on unemployment. And in that environment, they were too easy with monetary policy, which not only sparked inflation, but it ultimately didn't help the labor market. The 1970s would tell you to invest in bonds. Today, we're at the end of that 30-year bond bull market. We say just use them as a diversifier, short-term maturing bonds, and floating rate notes. We favor equities over bonds, but we would focus on those areas that can benefit from the economic recovery, your cyclicals, and also benefit from higher rates, so financials. Where we would avoid in the equity market would be those expensive areas like growth and technology. They'll be threatened by the higher interest rates and higher inflation. What we really like is the alternative space, especially in the real asset space. In the alternative real assets, they're designed to keep pace with inflation and should benefit from the ongoing economic expansion. The current economic environment does carry several similarities to the textbook definition of stagflation. And yes, we are going to have to deal with slightly higher inflation. Some of the reasons behind why inflation is high at this time is pandemic related. We have a significant supply chain disruption. We still have a very tight labor market. And as the Federal Reserve is navigating through trying to contain inflation, but also keep the economic expansion intact, the market's going to be volatile. We expect that. That's part of the reason why we're holding a little bit of dry powder in our clients' accounts in order to be able to take advantage of those opportunities. We're just waiting for some of those volatile times to present themselves and be able to put cash to work. And as always, if you have any questions, please feel free to reach out to your financial advisor. This is Megan Horneman, the Director of Portfolio Strategy at Verdence Capital Advisors.